now.
Thank you. Good evening, ladies and gentlemen. You know that we have done a series of webinar on the start of your own practice and management. And today is the 12th session, which is very important at the moment and very timely one. And the Members Relation Committee Chairman, Mr. Tishan Subasinghe, actually initiated this process. So it will be a very good session for you. And this is on the mergers and acquisition. So I'm not going to take time. You want to listen to him, and he's you all know everyone and can on the screen. He's on the screen. Mr. Shiluka Gunawardana, Principal, KPMG Sri Lanka. Shiluka, over to you.
Thank you, Suman. Good afternoon, everybody. Thank you for inviting me to this presentation. So let me, just to give some background, I've done a few slides and I'll discuss it as we go along. So maybe about 30 to 40 minutes, I'll do the slide presentation, and then we'll open it for questions and any discussion. And I think as much as the slides, the question and answer is important. Also, these slides have been shared with the Institute, and I've told Kavisha that I'm more than happy for it to be shared among the members if required. So a bit of my background, I've been with KPMG about 21 years. I was also in the Middle East for 6 years outside KPMG, but I joined in 1995 in audit. And after a few years, I went into consulting, and currently I lead the deal advisory team. So my main focus is around couple of things, M&A, valuations, due diligence. We also have a real estate advisory team. So that's my job. So I would say most of my 20-something years at KPMG has been in this field. And it's a very interesting field because of the challenge, the mental challenge, the fact that you're meeting people every day, meeting clients, and also helping clients to solve problems. And I think that's the thing that keeps me interested and keeps me around, I would say. So without ado, I'll go into our presentation. Okay, I hope everybody can see it. So today, M&A is a fairly large area. So I thought of focusing, and because we are mostly, the audience is mostly around practitioners, I'd like to talk about two areas primarily. One is the due diligence side of things, and one is the valuation. Both of these are fairly important from an M&A perspective. And maybe there are other topics we can look at down the road, but I thought I'll give the members a flavor of both these areas. And as I said, we can do a Q&A afterwards. So challenges for a business. Now, whether you're in the profession, whether you're in industry or anywhere else, most of us have same set of issues. Our clients also have issues in terms of funding, financial management, the optimum mix of debt equity, working capital, dealing with your suppliers, customers, etc. So there's a bunch of stuff, a bunch of issues that most of us face in our day-to-day lives. What happens is when you come into a transaction or M&A, while we are all good at operating our businesses, sometimes the back office or the housekeeping, you'll be surprised, in most companies is not very good. There's gaps in the information systems, gaps in reporting, compliance issues, various things like that. You also have simple things like, do you have a proper set of goals, objectives, action plans? Most of us spend our time running our businesses without really thinking too much. And when it again comes to a transaction, whether it's for you or whether you're doing some due diligence on behalf of a client, these are things that you start looking at when you come into a M&A situation. Some of these slides I'll move through quite quickly. So your funding requirements, source of funds. Sri Lanka, unfortunately, source of funds is a challenge. As I'm sure all of you know, it's either from your promoters or their family members. Angel financing is slowly starting to pick up. Bank loans and facilities, today it's rather expensive, but last year you could borrow at under 10%. And of course, things like private equity investments, which is somewhat, again, not well developed, but it's there. And of course, I haven't mentioned this, but IPOs and the stock exchange or the stock market being one of those areas. Again, this is straightforward working capital management. You'd be surprised again at how many companies let go of this particular area, especially around debtors and inventory, and also managing cash. Control and compliance, again, a very important area when you're looking at it from a diligence point of view, and I'll cover it later, so I won't bore you with the details. Again, very critical, especially when you're looking at the type of clients that we have. Majority in Sri Lanka, it's either own-operated family business or small and medium. Is the organization structure. Most cases, you really don't have a formal structure, but it works for them, and that's good. Are there defined roles? Do you have skilled staff in your front office and back office operations? Staff training? And do you outsource activities? So, for example, things like accounting, payroll, are potentially areas that you can outsource, which makes sense to do so in certain types of companies. Again, when you go into a due diligence situation, I know we learn this in theory, but it does, of course, in practice also. I mean, mission, objectives, goals. Why are you there? What is your market? How do you differentiate your product? What are your growth metrics? What is your profitability expectations? And of course, investing in people. Very importantly, again, because of the type of businesses we deal with, collaboration between the founding members or the founding family. Lots of time, this is where issues come up. The first generation has built up a business. Second generation may grow it. By the time it comes to the third generation, there's 10 people in the family, and it's not very clear who's doing what, and too many people get involved. So in looking at a due diligence or M&A or evaluation of these kind of businesses, roles, responsibilities, who's responsible for business development, who's responsible for the back office, is there a proper governance function? All these matter, and in a due diligence, these are things that can cause issues and potentially turn away buyers if your governance structure is not properly in place. So once a client decides to make a M&A acquisition, or even among yourselves, if you decide to go out and acquire another practice or start a business, for example, a few things that we all look at, and these are things we study, and in reality also it's what we look at. What is the investment value? Where are you going to raise the funds from? If you're looking at money from outside investors, then, for example, what is the percentage you're offering them, rate of investment, payback? Again, not really rocket science, but again, you'll be surprised in many situations where people or entrepreneurs have grown businesses. They've done very well, but they've built it without really formal structures. And only when it comes to transactions, or when they have to get in an investor or IPO or anything like that, that it takes a lot of time to get these things in place. And sometimes by that time it's too late, because they've grown to a certain size and they can't really manage operations and things fall apart. So getting into the meat of it is really, what is a due diligence? Simple definition is, I'll read it out: a comprehensive appraisal of a business which is undertaken by a prospective investor, generally by an accountant, or could be a lawyer, or could be a consultant, especially to evaluate its commercial potential and to establish assets and liabilities. That, in simple form, is what a due diligence is. My experience, these generally take between anything from 4 to 6 weeks. Sometimes it's longer, depending on the type of company you're looking at and the level of maturity. And normally you'll have a team of 3-4 people, partner, manager, couple of staff working on this. And in most cases, in my experience, we do the report, we do a presentation to the client. And then that, of course, it's really the starting point. At the end of due diligence is when most people start the negotiations. They may have agreed a price upfront, but with the due diligence report, you come out and start negotiating, because with that, our client, who's a potential investor, has a list of key issues. And on those key issues, he'll start negotiating with the seller. What are investors looking at? Lots of things, about details about the company, the industry, products, features, a lot of focus on management and the teams and the capacity of those teams. We look at the market opportunities. What are your existing competitors? Your strategies for sales and markets. Obviously, a lot of that time is spent around financial information, whether it's historical or forecast. What are your cash flows, historical and forecast? Valuation is a derivation of some of this, and I'll touch upon it later. And also, due diligence is never done in isolation. It's generally, there will be a lawyer or a law firm involved. There may be technical consultants, there may be actuaries, there may be people who do property valuations, surveyors. So there can be many other professionals and consultants involved. But today we are looking at obviously from a financial and tax point of view, and primarily financial. So coming into a due diligence, whether you are a member in practice or whether you are a member in industry, these are some of the areas that you'd want to look at. General housekeeping, basically your back office. How are your controls? How is your governance? How is your MIS systems and compliance? Compliance could be employee related, to EPF, ETF, all that, and also tax related. Financial and tax due diligence obviously is where we focus our energy in terms of your assets, liabilities, your projections, your revenue recognition, your whole thing around your P&L part of it, and of course the tax and the regulatory compliance piece. In some cases, we are also asked as consultants, as advisors, to look at the market. What is the market position? Are you growing? Are you deteriorating? What are your competitors? That's a market size due diligence. Sometimes, and this is generally done with a lawyer or a law firm, but there are, I mean, sometimes some of this common sense, you can look at it yourself, is around IP. So is the client's trademarks, I mean, have their names been trademarked? Are their products subject to intellectual property rules and regulations? Your whole corporate structure and governance documents, this you can obtain from your company secretaries. Litigation matters, again, lawyer would look at this, but from a common sense point of view to understand what is the risk there, and any matters relating to labor. Team diligence is, as I said, very important, especially in owner-managed or in a startup business. Who are the founders, the founders of the co-founders, how is their interactions, and how deep or how strong is the team that is supporting them. The due diligence process, as I said, can be 4 to 6 weeks, could be longer depending on the quality of information. I've had experience of due diligence that can drag on for months. Normally, we work on management accounts. If there is audited accounts, that does make our life easy. But, and I think being all accountants here, sometimes the quality of bookkeeping of some of the companies are not great. And that obviously means that you spend a lot longer time on the due diligence. So how it starts off is we provide our client a scope of work. We send the target company a preliminary information requirement list, which sets out all the information we want from a financial and tax due diligence. Field work commences, as I said, 4 to 6 weeks. We do the detailed analysis, the follow-up questions. Discussion on findings. Sometimes you have to be careful because you don't want to tell the seller exactly everything you found out, but you want to confirm factually that whatever your findings are factually accurate. And that's also the management comments that come with it. And then you report to your client. The client may ask for further information, further clarifications. So it tends to iterate a bit. And then you move on to your valuation and investment if the transaction goes to that level. Housekeeping considerations. These are, again, as accountants, very standard stuff. You know, the quality of your financial information, financial statements, are there proper policies and frameworks in place, and are the audits up to date? Again, in a lot of the smaller businesses that we deal with, a lot of this is not 100% there, which makes the whole due diligence process longer. And also, more importantly, it can impact on value. And that's the biggest issue that we highlight with founders and promoters, is having a proper set of accounts, investing in the right systems, in the right, having a good accountant, and having auditors audit your accounts saves a lot of money down the road when you want to go to a bank or when you want to raise money. Business overview, I think we discussed. Employee related considerations. Again, especially if you're looking at software, startup companies, a lot of it is around people. So your compensation, statutory commitments, EPF, ETF, those are areas you spend a lot of time in any service related business. Again, I won't spend too much of time on some of these. You look at revenue, you look at cost. Related party transactions, very important, because a lot of these companies have various transactions with their founder directors, with the family members. You have cars that are bought through the company. You have houses which are rented through the company. Various things are happening. So in a due diligence, it's obviously very important to identify those non-recurring costs, or let's say shareholder related costs, and take them out, so that a potential buyer understands exactly what is the cost structure he's acquiring. And sometimes in arriving at the purchase price, you add back. So for example, if the owner of a company is using a car which is owned by the company, in the transaction, you basically say, take the car and we'll pay you X amount over and above that. So you clean up the balance sheet also in the process. Contract arrangements, again, something that a lawyer would look at, but as accountants and from a very common sense point of view, your suppliers, your customers, your key contract with things like insurance, those are areas we look at. Employment contracts, EPF, ETF, very important because of the liability that it gives to directors, and of course gratuity as well. And taxation is of course a whole different area, and because of again, in a lot of the smaller companies, tax compliance is not 100%, especially when you come to a due diligence stage. This area can cause a lot of problems. Assets, we normally don't do a physical verification. If a client particularly wants, you might do sample counts, but you also look at ownership, quality, any impairment issues around it. You look at the CapEx cycle, very important for the valuation. Inventory, obviously, you do your standard checks. Again, we don't normally do a verification unless particularly required, but you're looking for systems controls, you're looking for obsolescence and impairment, and you also look at valuation of the inventory. Accounts receivable, especially with the current economic scenario, debtors and impairment is a big issue. So that's an area we spend some time on. Cash and bank is again around key controls and bank reconciliations. Obligations, third-party loans, any pledges, guarantees given, all that is covered under that. Accounts payable, you're looking at terms and conditions that you get from your suppliers, credit terms, are your payments on time, etc. Commitments and contingencies also would be in terms of any capital commitments or guarantees that you're given or anything like that, which is off balance sheet. So that really is a quick, tour of what a normal due diligence would cover. For the sake of completeness, and I know that we're not lawyers here, but these are some of the areas that we would want a law firm to look at if we are not looking at it. In most cases, as accountants or the financial advisor, we do look at it, but you also want, especially in larger companies, a lawyer to take a look at some of these areas. So especially supply agreements, if you're agency business, agency agreements, very important because of things like exclusivity, and agencies sometimes tend to move with senior employees. So you have to make sure that doesn't happen. Your distribution and supply agreements. And also, very importantly, your facility agreements with the banks. So what's the security? What are the terms and conditions? If there's a change of ownership, do the guarantees go off? Who brings in the new guarantees? All that is very important. So the lawyers will look at it, but as accountants, we take a look at it as well. Lease and rent agreements, again, generally not very important, but in terms of, especially for certain types of businesses, it's critical, and you would certainly take a look at that. Employment contracts and service contracts, you look at it in terms of compliance mostly, but also are there any special terms and conditions for senior management, like share options, or whether there is what you call sweat equity, especially in startups, where you get paid in shares basically. So those are also things that you would need to look at as part of, normally looked at by the lawyers as part of legal due diligence. But practically, I would say these are areas we should also cover just for completeness sake. So the next area, so we've done a due diligence now, no major issues. The next thing a client would probably want is in terms of evaluation, like what is the business worth. Evaluation itself is an art. It's a combination of between art and a science, I think. There is a science behind it, but a lot of it comes down to art. And historically, we've had problems because our stock market being fairly small and fairly limited. Trying to find things like beta was a challenge in the past. Now it's a little easier. But the other problem we have is because our risk-free rates are very high. When you take a risk-free rate plus you add the cost of equity in terms of beta factor, etc. Sometimes today, if you do a valuation, your cost of equity would be north of say 30%, and most businesses or most projects cannot work on that kind of it. So what we now do in the current scenario is for the next 1 or 2 years, we take a higher cost of equity, which could be anything over 25%. And we assume that maybe in year 3, 4, 5, the rates will drop down, hopefully with IMF and all that coming in. And we might then look at 20% and see whether the business is viable. If you looked at 1 year ago, if you looked at valuation of a business, a cost of equity of 12 to 15% would have worked. Whereas today, in the current scenario, you're looking at 25 to 30%. So that volatility is also very, very difficult when it comes to your planning cycle also. Because if you buy a company on the premise that your interest rates are going to be under 10%, and now we are paying 25%, it makes things like acquisitions very difficult. But that's the country we live in, so it is what it is. Why is a financial model needed? A couple of things. One thing is to establish value. It's also a way of putting into numbers your vision or vision of the founders. It's a way to track progress. So you do a 5-year business model, and every year you make sure your budgets align with that and with your tracking that progress. Because if you want to work out your actual payback or your actual ROE on acquisition, you need to track that against the business model that you used at the beginning of the transaction. And also to meet your funding requirements, to identify your gaps in the cash flow and how you fund it. So 2 approaches to forecasting numbers, and I think this is, again, in reality, it's also the same. You look at the market, one approach, you look at the market size, you work out the subsector, and then you work out your company share. And that's generally probably the easy way to do it. If you take the petroleum market in Sri Lanka, we have CPC with 85%, we have Lanka IOC with 15%. You know your consumption rates, you know that LIOC may not sell kerosene oil, and you can work out a valuation of those businesses. The bottom-up approach is you start with petrol, diesel, kerosene. What are the demand drivers? What are the conversion rates? What are your market growth rates? And you build it up into a set of sales numbers. So either one is fine. In some cases, you have enough information to do the top-down approach. In some cases, you don't. If you have enough information, ideally you use the bottom-up approach. But in some cases, if you don't have the information, you end up doing the top-down approach. So key inputs into a financial model, and again, this is, we are accountants. I think we all understand this. Your revenue is very critical. So ideally, you try and go into as much detail as possible. You shouldn't just be taking last year's revenue, growing it by 15-20% and expecting a result. So you try and drill down to the lowest possible subsector or category or segment, and then individually model the revenue growth and then add it up to arrive at the total sales number. Cost of goods, again, very similarly, you try and drill down to the lowest denominator there so that you have a good idea, because in most cases, COGS is at least 60, 70, or 80% of your total sales value. So it's very important to arrive at your cost of goods or to derive your cost of goods in an accurate manner. Other operating expenses, essentially your fixed costs. In most of these cases, some of them you can drill down, some of them is more like a growth factor. Again, keep in mind that in Sri Lanka, with our cost inflation, our estimate of electricity prices last year to this year is different. I saw today that water prices are going up. So yeah, that's how it is. But you generally try and take an inflation adjustment to your fixed costs and derive your operating expenses. 2 other areas, which again, some of these will come, some of this information will come from the due diligence, is about working capital. Again, you're looking as much details as possible about your inventory turnover, trade receivables, trade payables, because this has a very direct impact on your cash flow and therefore your valuation as well. So, your cash conversion cycle is very important, and arriving at an accurate number there is also very important. to get the best valuation possible as well. In the case of investment in assets, so this is your capex. You look at the historical capex, you look at your current capacity utilization, you look at your asset replacement cycle, and say over a 5-year period, you try and estimate what your capex requirement is. In case you don't have the details or the owners don't have an understanding or the business potentially is at a certain steady state, then what we do is we assume that capex is equal to depreciation. That's not an ideal solution, but at least it gives an idea that there is no major loss in the value of the asset base. So if your depreciation equals to your capex, then what you're saying is that the asset base will be fairly constant over the period of time. So the outcome of all this is, again, detailed income statement. Depending on the level of information you have, you can do it monthly, quarterly, annually. Generally, if you're doing a 5-year forecast, maybe the last year 3, 4, 5 is annual. Maybe year 1 is monthly, year 2 can be quarterly, because anything beyond that, and you're just making guesses. You're also obviously focusing on your key metrics, GP, OP, NP, ROE, EBITDA as well. And those are the numbers that you have to constantly keep looking at and then tracking back against historicals and what is your actual results in the future. Balance sheet, why it's important is in terms of it has impact on your valuation in terms of your NAV partly, and also in terms of, if you're borrowing, for example, the size of the balance sheet is important. And cash flow statement, cash is king, as they say, very important, especially in times like this. So focusing on cash collections, cash inflow, outflow, managing your capex would directly impact your valuation. So we have 2 primary valuation methods, and I'll cover this in a little detail. One is called the absolute valuation method, which is essentially based on cash flows, discounted cash flows. So within that, we have 2 methods we use. One is called the free cash flow approach, DCF, and one is called residual income. Residual income, and I think we've all learned this in our studies, is that residual income is primarily we use in things like banks, financial institutions, insurance companies. So anything with financial instruments and assets, we use a residual income approach. Most other companies, you can use a DCF approach. You also have the absolute, another method is the asset or NAV-based method, which is basically your value of all tangible and intangible assets and maybe some adjustment for goodwill. Goodwill, you have to be a little careful, because if you look at it, if you take a DCF method, the present value of future cash flows is a number. If you deduct your NAV from that, in theory, the difference is intangible assets / goodwill. So some people tend to take a DCF and then add a goodwill factor, which we say doesn't work. Because in theory, if you've done your models right, your DCF should be equal to the total value of the firm. If you deduct the assets from those, what you end up is the difference is goodwill. We also have the relative valuation method, which works if you have a developed stock exchange, where you're looking at multiples. So whether it's things like price earnings ratio, price to book ratio, price to sales ratio, or if you look at historical transactions, so comparable companies, comparable transactions, you look at a comparator and then apply that to your target company's results, whether it's sales, EBITDA, profit, book value, and get a valuation. So in most cases, when you are doing a valuation, we look at least minimum 2, if not more methods. We use DCF as a primary valuation method, and we always use multiples as a secondary valuation method. In very rare instances, if for some reason there is just no way to get a DCF, then you might use multiples initially. But ideally, at somewhere in that process of a transaction, you would really want to do a financial model and do the DCF calculations. Again, maybe in a little more details, if you take DCF, there are 2 primary approaches. I won't go into too much of details, but one is free cash flow to firm, which is essentially valuing the business, the cash in, cash out of the business, without adjusting for the financing, whether it's financed by debt or equity, doesn't matter. We look at cash in from sales, cash out for expenses. What is the residual cash flow? We value it at the weighted average cost of capital. And that is your free cash flow to the firm. From that, when you deduct the debt, the value of debt, you get free cash flow to equity. So that's one methodology. We normally use these for certain types of businesses where, for example, the gearing levels are very high, or it's potentially a business with a heavy capex burden. We would use free cash flow to firm. The other scenario or the other method is free cash flow to equity, where it's very similar to the FCFF. It's just that in the cash flows, we take out interest payments, loan repayments, etc., or preference share payments or anything like that. So when you discount those cash flows by the cost of equity, you get free cash flow to the value of equity. And those you would normally use, or this method you normally use in situations where, for example, there is not much of leverage, or maybe early stage business where it's difficult to forecast the capital structure, or a company that has reached steady stage and there is no significant debt involved in that business. We would use the FCFE method. Right. So coming to the multiples approach, again, as I said, this is not a primary valuation method. Ideally, not ideally, always you would try and use DCF. But in case as a backup, or in case sometimes where you don't have the data, you can use multiples. It gets a little more complicated, and we do a lot of these startup valuations because there is no profitability, sometimes there's no gross profit, there's no EBITDA, all you have is some revenue. But you also have a lot of other metrics, especially when it comes to startups. You'll have how many customers you signed up, how many clicks you have, how many visits per website, how many merchants you onboarded. You'll hear a term called GMV, gross merchandise value. So those are metrics that you can use, where you look at potentially a company in India or Malaysia or Indonesia, similar size of company. You look at their multiples, you take it and apply to some metrics or some basis of your startup. So in the case of a lot of the startup valuations, we have to use a multiples methodology because the business is at a too earlier stage to do a proper cash flow based valuation. And sometimes the only method is to use the multiples based valuation. Of course, the key thing there is that identifying a suitable peer company or peer companies. You don't use one, you use multiples of them. And generally what we do is we use things like Bloomberg or Capital IQ to get the data, but there are other websites also that are available where you can get this data as well. So again, when it comes to multiples method, it's a backup method. You have to be very careful, especially when you're selecting your comparable peers. But sometimes in the case of early stage companies or startups, it's really the only method we can use. So yeah, that is my presentation. I'm happy to take questions from the audience and the members.
Thank you, and very important presentation. Great one, and very good presentation again, Shiluka. Few questions from me, Shiluka. I think I can see the audience also actually trying to send some questions. But I would like to start the session. Yes. What are the key factors actually should focus on this M&A?
Okay. So I think it's a couple of things. It is really, as I said, preparation is very important. So most of our clients, and whether it's a large firm or a small firm, a lot of them have started off with one founder, maybe a couple of founders. They've grown the business. They're doing very well, right? They're running very good businessmen. They're doing great in their business. But when you're trying to bring in an investor, you're trying to bring in an IPO, do an IPO or anything like that, their back end, their back office, their systems are very, very weak to the extent that there may be even things like frauds and stuff happening, or it's very difficult to identify the underlying profitability because a lot of it is very informal. It works for them, nothing wrong with that. But the moment you're trying to sell the business or you're trying to go out to the stock exchange, if somebody comes and says, what is your profit? Sometimes it's very difficult to establish your profit. Or are you paying taxes or your EPF, ETF? So what we say is if you're a founder or a promoter or you're a family business that is trying to grow, at a certain point, you need to get your systems in order. Right? Proper accounting, proper systems, proper controls, proper accountant, because that investment, which might take 1 or 2 years, and there is a cost involved, no doubt, will significantly improve your value when you go to the market or when you're trying to get invested. Right? If you can show a set of audited accounts, which is done by audited by a chartered accountant, and you have 2 or 3 years of those audited accounts, and you don't have 2 sets of books. So unfortunately, that's something else you see. Some companies have 2 sets of numbers. If you can show them a proper set of accounts, immediately the buyer is comfortable that I have no issues, I can trust the numbers, and I'm maybe willing to pay more. If I was willing to pay 5 times for a business without proper accounts, maybe I'll pay 7 times for a business with accounts. So preparation, having your accounts and documentation in order adds a lot of value if you're looking at an M&A or an IPO situation down the road.
Now, Shiluka, you actually touch on that area what I really interesting. Now, when go for a acquisition, there are maybe people are actually considering the profitability. Today, the profitability you can show the way you want, right? And also the figures are actually really inflated. But there are circumstances I have experienced, Shiluka. Inside the business, there are some venture capital arrangement, there are some understanding agreements. As although the business need for them to go for a let's say IPO or expansion, but barriers are or the pitfalls coming from those arrangements and also the agreements or the understanding, right? Let's say billions of turnover is there and the profitability is there, but some of the conditions and the contents of the agreements where with those ventures or the understanding which they have not honored up to now, as a result, they cannot go to the next level. What is your advice on those circumstances to make it actually a profitable the business and future that will be profitable for the ventures as well, right? So what is your advice, Shiluka?
So normally, what we tell when people come and initially have a conversation is, we say, see, it's easy to say, go and raise some money, go for IPO, right? But you have to be ready for it. So what we say, sometimes take a year or two, sort these things out. We understand you have arrangements. We understand you might not be paying proper taxes. You don't file tax returns. EPA, VTF is a mess. No problem. Understand. Spend maybe 1-2 years and sort it out. Right? Get a proper account and get a system. Get your numbers audited. I know, and as all accountants, sometimes you might have sales not recorded. We say slowly bring those sales in. Bring those sales in so that over 1-2 years you show proper sales. When you show proper sales, you can show proper profit. Pay your taxes for those years. Get your numbers. Don't rush unless you have some major urgency. Spend 1 or 2 years and get your books into place. Because if you were worth 500 million earlier, as is, if you do this, you might be worth 1 billion rupees. So that 1 or 2 years is actually adding a lot of value to the owners and the investors, simply by getting that housekeeping in order. If you go without that, somebody will look at all this and say, a lot of problems. Instead of 500 million, I'll pay you 250 million because I have to sort out all your problems. That also happens, unfortunately.
So actually always better to have the discussion and keep it ready, everything, and get the understanding on and have the sessions and with the proper understanding, move it forward, your advice, isn't it?
Correct. So what we also tell people is, okay, now our tax rates might be going up, but if you pay your taxes or pay as close as possible to the right level of taxes, you don't have to worry about it down the road.
Exactly. This is why my second question. Now, when you go for the tax DD, you may even for the DD you may not get the clearance. right?
Correct.
Because they have not paid VAT. They have a lot of areas. Even in NBT, ESC has not properly gone through, and income tax they have never paid sometimes, and all the in the with the department or the letters they have received. So these are actually barriers, and they don't want to get clear. As you said, if before you go for these mergers and acquisition or whatever, you need to keep the house in order, isn't it?
Very much, very much. Well, otherwise, the buyer comes in and looks at it and says they basically reduce the value, or they'll
Yes,
ask for representation and warranties, or they'll just walk away, saying it's too
agree,
complicated. Don't want to take this risk.
agree. And I have a question from the audience. I will share with you how I think you have answered this. How we can ensure the real value of business is captured, considering its future potential, rather than rely on its future CF cash flows being forecasted. Considering under the current condition, yeah.
Yeah. So this is where the valuation is a bit of an art, right? There is no right answer. We've all studied about the DCF method and WACC and all that is fine. But ultimately, if you have 10 accountants, they might have 15 different values. Right? But ultimately, it is as a professional, if I'm looking at a buyer and seller, I would want them to do a transaction where they're both ultimately happy. The buyer feels that he paid a right price, the seller feels he got a good price. Now, normally, as much as we accountants will come up with valuations, a lot of that is negotiation.
Yeah.
Right? The seller will start at 1 billion, the buyer will say 500 million, and slowly both sides, So if you can end up at maybe 750. So a lot of this is the valuation helps towards guiding the buyer and seller to a right number. It's not perfect. You might get it completely wrong, but at least if you use the proper methodology, if you have the right information, you might get close to a number that both parties are willing to work with. And ultimately, that's what's important.
Right, understanding and the negotiation.
A lot of it is negotiation. Ultimately,
Yes.
two people sitting around a table and trying to work out what the number is.
Exactly. Great. And now, when come to the HRDD,
Yes,
you can hear me, right, Shiruka?
I can hear you.
Yeah.
I can hear you.
HRDD. Now, do they need to get the clearance from the ETF board, central bank?
Normally, we don't get clearance. We look at the returns being filed. So as long as the returns have been filed up to date, we normally don't get an independent clearance from the EPF ETF.
Okay.
Unless there are labor issues or there's been some arrears which have been negotiated, in which case we look at the correspondence. But most companies don't want us to. In the case of the Inland Revenue, you can get the assessment from the RAMIS system. That's okay. We use that, and then we look at the filings. EPF, ETF, we look at the returns and the payments.
That's
Those are
adequate.
generally out there. We are okay with that.
Okay. One common thing
Sorry,
now.
one little thing that we come across in this is, and this is almost every company in Sri Lanka, there are allowances you pay, travel allowances, allowance, all that. If it's a fixed allowance, you have to pay EPF, ETF on this.
Yes.
But 99% of the companies in Sri Lanka will not pay EPF, ETF on these allowances. So immediately you have a problem there, but then that's a problem with every company in Sri Lanka. So we highlight that and say there is a risk, but then everybody is doing it.
What is your understanding or the practice actually, according to you have done quite a lot, the retention of staff when we come to the HRDD, how actually continuity of them, what sort of contract actually need to have into, even that I think continuity is an issue. How you can share your experience?
So I think a lot of it, ultimately comes down to culture. Especially if there is a founder or one or two key people, if they look after their staff well, you'll see 20 years of people are there. They're not getting paid a lot of money, but they're happy with the founder, they're happy with the job, they're okay. There are other cases where people are getting paid a lot of money, but you'll find them leaving often because the culture is bad. So what we look at is, when we look at the HRDD, we look at the salary scales, we understand whether it's market related or not. We look at the benefits and all that. We look at the employment contracts. Some of these will have employment contracts which says that if you leave, you can't join a competitor for 1 or 2 years. So we highlight those factors. But ultimately, keeping people is a factor of the culture of the organization. And sometimes in acquisition, the buyer will say the top 5 people, I'll pay them something in 2 years. If they're still employed for 2 years or 3 years, I'll pay you like a bonus at that point. So those kind of arrangements also you can come.
And also, it's an issue on the change management everywhere in the market. Yes, understand. But
Again,
it's a very big challenge when it comes to the textile acquisitions like that, and specific businesses. Some of the employees are key oriented people. It is a tough challenge for the buyer, isn't it, Shiluka?
It is. So see, most transactions fail not because of the price being too high or anything. It's just that
yes,
you are not ready to take over the company.
That's right.
So a lot of people walk in, they try to make changes. Sometimes you have to be a little careful about the changes, which slowly make sure the existing team run. And then you start putting your systems and controls in place. If you try on day one to change everything, invariably you have a lot of people leaving, and then that creates issues for some time.
Yeah, in your career, Shiluk, sharing experience now, when you come to the public sector, like plantation companies, like other government-oriented organizations, when you are engaged with, now they say, you see some of the aspects, they trying to get a discontinue or continue some of the operation, like let's say for an instance, it's a very large plantation company, they don't have experience on the export market. Right. So now they are going to engage with the company or issue the shares for that company if it is semi-government and get the engagement done. But when you really analyze and see that, you can understand backward in the plantation company itself, they have the caliber, they have the capital, they have the staff, everything. Right. Then what would be how you actually give you a consultation in the reporting side with both management, how we are going to evaluate that type of you got my question, right, Shiluka? Yeah,
I think so.
Yeah.
I think
sometimes it comes in the mind, we need to protect the public properties and also our own plantation companies, and all these things come to your mind, right? But still your engagement is on whether this acquisition is good or bad, right? You need to give a decision. So when come to the engagement side, are you giving an advice? Okay, why don't you go this way? Why don't you expand like this? How you're reporting that on that manner.
So it depends. If it's purely a due diligence, we might limit, being accountants, your scope of work. You will limit it to the scope of work, which is assets, liabilities, financial statements, and all that. But your question also again comes down to culture, Saman.
Yes.
So the culture
exactly.
Right? You're a semi-public, semi-government organization. You're trying to buy something which is private company, right? The cultures are very different. So chances are you buy this company, after 6 months, half the people in that new company leave. Right? And all that talent and what you're paying for is gone out of the door. Especially in the tea export business, a lot of it is very personality. One or two people know the buyers on outside, and if they leave, that's the end of that business.
Yes.
In most cases, the business goes down. So when you're buying or when you're looking at opportunity, like you said, you have to be very careful to retain the people and also incentivize them to stay. So the culture is important, and the incentives for those people to stay is also important. If you can't get those two right, you might as well not buy it or go ahead with it.
Thank you. Shiluka, there is another question from the members. I would like to know what is the process of find out pending litigation. Okay, when it comes to an acquisition. Okay, clear
So it's always a good question because unfortunately in Sri Lanka there is no register, there is no legal register. So a couple of things we do is obviously if that party has a lawyer, a law firm or a lawyer, we ask them to give a representation of any legal cases pending. Then obviously you can search, Google search or whatever it is and see whether there is any public announcements about litigation or anything like that. But to be honest, it is a challenge in Sri Lanka because there is no central registry. So normally we depend on a representation by the sellers that there is no litigation. That representation is put into the legal contract in the share sale agreement. And we also have penalty that in case within 1 or 2 years we get to know that there is some litigation, then some part of the sale price might be clawed back. So normally there is representation and warranties, and you might say 10% of the purchase price is kept in escrow, or 10% of the purchase price is retained. After 1 or 2 years, if there is no problems, not only legal, EPF, ETF, taxes, all that, then we'll pay you the 10% to the shareholders. So that's how we normally do it in practice.
Yes, yes. Very, very difficult question to answer, and very difficult to, area to cover for when you come to the DD. Yes. There is another question from me, Shiluka, for you. Now, when come to the audit firm, our all practitioners. Now they do small. Actually, even I receive some of the phone calls from our practitioners on what sort of reporting format they should make, right? Because this is a liability concern, it is huge, right? And also they have only the audit firm. They don't have, consulting firm. And also they don't have any other liability company, right?
Yeah.
And how do they now report even a valuation of shares, right, of a company? How do they put? So the question is, how is the liability side and to a partner, and also which reporting format says they should use, and how to pricing at the end of the day, right? So these are 3 questions. Shiluka, share the experience, please.
Yeah. So liability wise, I think maybe different firms are, but if you take where I work at KPMG, we normally limit our liability in the engagement letter to 1 times fee. So basically the fee. So if the fee is 500,000, our liability, unless there is fraud, negligence, few things like that, is the fee. And we hope that there is no fraud and negligence. So generally that is this thing. In terms of reporting structures, so some people use Word, some people use PowerPoint. If you go on the internet, there are different report structures. But generally my advice is, because I've been, in addition, I was in industry, I was in practice. So when I was in industry, if somebody gives me a 50-page report, I'm not going to read it. I'll look at maybe the first 5 pages. So what I tell my team and what I would tell anybody is keep the report simple. In the first 5-6 pages, give all the information that you have to do, and then the analysis, maybe if you want, you can look at it. So whether it's a Word document, PowerPoint document, that executive summary with all the information is important. It can be, you can do a 50-page report and a 10-page report with the same substance at the end of it. I will always go for the 10-page report because that's easy for me to read. So that fee, of course, is always a negotiation. And nowadays, of course,
the firm or the company?
Which one? Sorry.
Is it going through is it going from an audit firm or a company, limited liability company? So
we have a limited liability company at KPMG, but we still issue our reports to the firm.
From the firm.
From the firm. But I mean, I know some of the other accounting firms are private limited companies. So things like valuation, consulting, due diligence, you can do through that. In our case, I mean, as long as you do a proper job, whether it's a firm or the company, doesn't matter. So we are okay.
Okay. And another SME point of view question. Now there are companies or some of the acquisition, some of the not say mergers, some of the acquisition, they don't have records. They don't have nothing, right? But huge business, right? And you know what is I'm asking. So why don't you share?
Yeah, so those kind of things, one can, so it's more than a due diligence, then it's more like a, I wouldn't say forensic, but it's a bookkeeping engagement, right? So you start essentially look at the cash book, and hopefully there is, so sometimes there are bank accounts that they've forgotten us. There is so much of money in the system. So you get told of all the bank accounts, bank statements, slowly build up the, trying to build up the profile of the cash movement. So instead of a 4-week due diligence, you might spend 4 months trying to build up the accounts. So they are essentially, you start from the bottom up, building up the picture of the, cash in, cash out, and then trying to slowly make a P&L out of it. And then hopefully the balance sheet, if there is a balance sheet. So it's a lot more effort, and essentially instead of a due diligence, you're doing bookkeeping. So that's where that preparation is important before it comes to that point, to prepare early so that you don't end up with a bookkeeping engagement. Because sometimes the person who's buying it also gets tired of it after 4 months or 3 months. if you're still trying to figure out, how much of sales, what the sales number is, they also get tired and they get worried.
And still that will go on the basis of negotiation, more or less, isn't it?
So they are what
I lost. Oh, she lost. Hello, Kavisha, can you hear me?
Yes, sir, I can hear you. I think due to network issue, Mr. Siluka's connection is
got disconnected.
Interrupted.
Yeah, I think but a few minutes to finish the session we have. But it's an interesting question because he was answering. Shall we wait for a minute him to come back?
Yes, we will wait for a minute. I will check.
Thank you.
Mr. Srilal, he will back in a minute.
Yeah, I can see that. Yeah, great. That's great.
sorry, someone.
No, it's all right. It's all right, Siluka. It's natural.
Had a power cut. So responding to your question.
Yes.
In those kind of situations, what we would do is we would recommend our clients to maybe take you don't buy 100%, you buy 50%, 51, 60%, and make sure the owners remain in the business for some time.
Yes.
Once you're comfortable with the numbers and you get your systems in place, then you buy the balance shares. Or you buy 100% but pay only 75 now and say the balance I'll pay you, after 1 or 2 years when I'm comfortable with what the business looks like.
That's great. That's another question. Only 1 or 2 questions, Siluka, more. As you explained earlier, with the high cost of capital, stroke inflation, etc., what would you expect that M&A will slip out of the picture because of investor has more streams to invest their funds? Yes, of course, opportunity is there, but Siluka.
Yeah, so that is maybe if you take the last 3-4 months, people are buying. So earlier people are buying cars and houses because bank interest rates are low and the stock market was not doing well. Then the stock market picked up. So it's a cycle. But what happens is there are companies even today with a lot of rupees. Right? They made some money. They have a lot of rupees floating around. So a lot of companies are looking for export businesses. If you have only purely a domestic business, you can't find dollars. You're trying to buy an export business to get dollars. So even in this current climate, there is M&A, but people aren't borrowing because you can't. Either it's too expensive. But if you have surplus cash, and there are enough companies with surplus LKR, then they're using that LKR to make acquisitions. There are also companies who are strong in one area. There are even exporters who are saying, maybe now, the prices will drop down. Things will not be as good as I'll put some of that money into another business, like a tech business or some other ancillary business. So even now there is a fair amount of M&A happening in the market.
Thank you. Thank you. One last question from me. Quite interesting area actually this is, but I need to finish it off. Now, when come to the valuation again, right? From the beginning, I am going back to the initial stage, brand valuation.
Yes.
Right. Then there are a lot of companies they are doing the valuation and getting the figures up in the balance sheet and come to the market and offer the prices, right? And what is your advice for the CFOs point of view when they get ready for the sell or merge?
Yeah, so brand value, I mean, we do brand valuation to do the purchase price allocations. Generally, standalone, you won't see that happening. But what we again tell our clients is if you do a proper DCF, then the cash flows reflect the value of the brand. So by default, your DCF value minus your asset value is a lot of things, but inside that is your brand value also. Now, if you want to separate it out, you can, but there is a lot of work involved and it's quite costly. Because you have to get data from, you have to buy certain data from overseas, and it's not a science, it's very much an art. So mostly what we say is do a proper DCF valuation. Within that, your brand value is embedded. If you want to do it separately, you can. It just takes a bit of time and cost.
Okay. Okay. So, Shiluk, I think, Kavisha, we can wind up the session. And thank you so much, Shiluk, and accepting our invitation and coming and doing a very nice presentation, very useful one. And on behalf of the chairman of the Members Relation Committee, I thank you very much for your presentation and also answering all the questions. I don't think there are more questions in behind. Yes, and did very well. Thank you so much, Shiluk. See you again. Thank you.
Thank you.
Thank you.
Thank you, Kavisha.
Thank you. Thank you.